Hello and welcome to our latest urgent market update video, which is brought to you by the Live Trader. Now today is Monday the 18th of December 2023, and this video we wanted to just pause. After Wednesday night's FOMC, we saw a major market reaction and we've seen very little price action since. So we wanted to see how the week was going to end, and then we wanted to put this video together. So what we'll be looking at is fairly limited follow through in the US indice markets, for example, post this extremely dovish and quite surprising FOMC event last Wednesday. So the question we're going to ask is why and where do we go from here? So let's get straight into it then. Okay, so hello and welcome. Thanks very much for joining us. Let's literally get straight into this topic because it's quite interesting what's happening, and what it's doing is it's putting a bit of doubt in the commitment of others. So you know, we have your market makers, you have your Wall Street banks, you have all your participants in these markets, and they're all sort of just backing off, it seems, a little bit. So we do want to break down a little bit in terms of why that's the case. And where do these prices go from here, and in return likely to give us some fantastic opportunities when these markets do start to move, because they've not really moved in line with our expectations on Thursday and Friday. So let's break this down for you. So before we begin, if we can as always start with our risk warning, take a brief moment to familiarize yourself with our risk warning currently up on screen. And let's get straight into it then. So the first thing we want to show you is, if you look at the S&P 500, it's quite a good barometer in terms of what we're talking about. And you can see the move that we've seen on Wednesday. It's this candlestick in here. Let me just identify it just there. So that's last Wednesday's candlestick. Very bullish in nature. But look at this price action on the smaller time frames. So look at the price action we had in the build up to that FOMC. You practically very, very little range in the whole trading day prior to that. Now, we subsequently got a rally for sort of 4 or 5 hours. But as you can see, prices have yet to kind of breach those significant highs. So we've not really had a follow through. On Thursday, we kind of rolled over to the downside. We made another attempt to push higher on Friday. That failed. And we're still in this like consolidative sideways moving pattern. So hopefully that's straightforward. But just want to share this particular candlestick here. It was 1 hour of very, very aggressive buying. And it was really a little bit of a surprise for us. So let's explain what the reason for that. If we go back to last week's FOMC on Wednesday, we had some better than expected, broadly speaking, inflation numbers due out on the Tuesday. We had headline inflation in line with expectations, but slightly lower than previous at 3.1. So we've got inflation down to 3.1 from a very significant 9.1 if you go back to the summer of last year. And then just prior to the FOMC, we saw significantly better input prices coming down again, significantly lower than expected, especially on the core PPI numbers. So as a result, we weren't too surprised to get a pause at 5.5%. We've been up at these elevated levels now for 4 meetings. So we wondered at what point the Fed would, because what we know when we pause in these markets, if you look at these highs in here, and we'll go back even further, you know, something we can notice over the last 20, 22, 25 years is that when we pause at these highs, we stay there for a specific period of time. And look what happens next. We generally get that strong lowering of interest rates. And that's very much what's been priced in. So it's really a question of how long will the Fed keep rates at 5.5? It would be a big surprise if they started raising rates again, even though they're saying that they're always going to keep an eye on making sure that inflation is coming down. And if it starts to come back strong, then the Fed will have to go through a series of further rate hikes. But the market is really not pricing any of that in. And what was interesting, if you look at the economic projections on the dot plot, is that there's been this shift from FOMC members to actually go through a process of rate reductions. So that's bringing this interest rate down from 5.5%, potentially down to maybe 4 or 4.5. So that's what the surprise was. And then we heard from Jerome Powell in the press conference, and he basically alluded to that effect that the FOMC will look to bring down rates if they start seeing inflation continue to lower, and they'll start making those steps. So this is when we saw this very significant market rally. I don't think we certainly weren't expecting that rally, and I think a lot of market participants weren't really expecting this very sizable. And don't forget, we're coming from bottom left to top right, so we were already up at these elevated levels. But what's happened effectively is that the Fed have given a further green light to these equity markets to rally. And it's off that rate pivot narrative. So this is where it gets quite interesting. So we're looking at this narrative on the left-hand side of your screen, and you can see the first one there is dovish Fed, rate pivot. Now, we've been looking at these narratives for a couple of years now. Broadly speaking, as soon as the Fed were talking about this transitory inflation dynamic, and that was always going to likely drive market direction to a certain degree, and then the market started to rebel against what the Fed were doing, and they're continuing to do so now. So when equity prices rally, it generally has a loosening effect on financial conditions, which is not really what the Fed want to see. But they do have this Goldilocks scenario with really low employment, really low unemployment, a functioning, reasonably well-performing economy with inflation coming down. So they're ticking a lot of the boxes, and as a result, the Fed are now talking and have reaffirmed that position that they will look to reduce rates, it seems, in 2024, unless something significant changes. So the markets have taken that sentiment and they have rallied. So we've got a risk-on market condition as a result of that rate pivot narrative, which means US indices higher. That dollar, we'll have a look at the dollar in just a second, because that's not as straightforward as we're seeing in the indices. But bond yields have continued to lower to really quite an alarming rate. And we now have the 10-year, just as a little example, we've got a 10-year, which is really below that 4% mark. We've rallied from 5% to 3.9, and you can see that that's continuing to roll over to the downside. And that's really what's of interest to us. So generally, when you see these bond yields rolling over to the downside, they're very positive for equity markets. So it just means there's an element of risk coming out of these trades as affirmed by the central bank. So it's that Goldilocks scenario. The question is, so that's why we had the move. So the next question is, why have we not seen the follow through that we would have expected? And that's these markets breaking higher. Now, there's every chance at the point of recording this video that we will start making new highs in the S&P 500 above the 47, 45, and we'll probably head for all-time highs. So that's very much still on the cards. However, we do question if the Fed, if the dovish Fed narrative that's these markets have grabbed hold of, why have we not seen a little bit more than a 60, 70 pip move? We would have probably expected that to be a multiple of that, and we've not seen it. So we've gone into this little sort of sideways pattern, and that's really the the explanation that we can give to that is perhaps the markets have kind of overrun the Fed a little bit, it seems, where there could be, if you look at inverted yield curves, the difference between 2 and 10 year, we'll bring the 10-year just back up just for your information, and we'll compare and contrast the 2-year against the 10-year. You can see that we're still in heavily inverted markets. Yes, bond yields are strongly rolling over to the downside, but we've still got this inbuilt risk factor, and that is potentially what's causing a certain degree of this hesitation in these markets. And really what the narrative is beginning to shift towards is hold on a minute, what if the Fed are not reducing rates because of inflation, but what if they're reducing rates in advance of a recession coming down the tracks and they're trying to sort of front run it? Then that would cause a lot of fear and anxiety. And under a situation like that, where we'd be focusing on kind of recessionary fears, we'd actually be looking for the opposite. We'd actually be looking for risk-off market conditions, which would mean indices could very well roll over to the downside. The dollar could extend its strength in these markets. It has been rallying over the last couple of years. More broadly, we're at the process of weakening as things currently stand. So these narratives could shift very, very significantly from one to the other. So we, as a result, as traders, because we can benefit, we can trade this type of dynamic. We can very much look to buy these markets. If there's still this positive risk on sentiment, we'll look to buy it. However, if that sentiment starts to turn a little bit more bearish and we see these prices starting rolling over to the downside, we could very easily look to sell that type of dynamic. So we'll buy it if prices continue higher. But if prices show signs of rolling over to the downside, we could look to position ourselves actually with that recessionary backdrop in mind. Now, we were talking last month about this Santa Claus rally, and we think that's broadly in play. So if you want us to make a call, we probably expect by year end that these equity prices would probably be higher than these current levels. So that's our base case, but we will be keeping a very close eye on that shifting narrative. And that's really, have these markets overshot the runway a little bit? We shall see in due course. But that's how we'll be looking to position ourselves with this, let's just say, indecisive price action right now. So hopefully that has made sense. That's kind of breaking down, not the initial move. We understand why that's happening, but really it's looking at the sideways moving pattern and how that could lend itself to a bit of a shift in narrative. And if that happens, that's likely to present some potentially some decent opportunities to the downside, believe it or not. Okay, so that is further compounded, just focusing on the dollar just quickly before I let you guys go. If you look at something like the euro dollar, you can see that Wednesday and Thursday we saw a strong rally, which is the dollar weakness trade, which is very much in line with expectations. But look what happened on Friday. This suggests that these markets may have indeed sort of been too bullish too quickly. And there is a bit of profit taking, a bit of retracement, but it just remains to be seen where we go from here as far as the dollar is concerned. So that dollar is going to be a part of that shifting narrative. So hopefully that makes a little bit of sense in terms of what's happened since a very dovish FOMC on last Wednesday, where we saw an explosive move to the upside. But since then, we've literally drifted sideways. And that just opens up the door to perhaps questioning further upside moves. However, we will let price action decide whether we're looking to continue to be buyers in these markets, or whether indeed we'll actually get a bit of profit taken up at these highs and we get a bit of softening going into year end. Either way, it's going to present some fantastic opportunities, very likely in January. So it's all ahead of us. So fascinating market conditions as things currently stand. All right, then, guys, on that note, any questions, do feel free to email us at support@thelivetradesroom.com. Thank you, as always, for joining us. Do stay tuned for our next video. If you are interested in learning how to trade the financial markets, you can access one of our discounted. They're currently discounted prices. We have a live trading bundle and also an education bundle as well on our website, and it does start from as little as $59 per calendar month. So do feel free to go to our website and connect with us through our chat box if you have any questions about all things related to trading. So on that note, and our website is thelivetraderoom.com, so check us out there. Great stuff. On that note, we do wish you a lovely Christmas break, and we will probably be getting out another one of these videos in and around the Christmas period, perhaps even during the Christmas period. We'll kind of have to wait and see. It depends how these markets interact. But hopefully we get another one out. So if we don't speak to you before Christmas, we hope you have a safe and happy Christmas, and we look forward to seeing you again in January. Take care. Bye for now.